as Brian said, we do have losses continuing today and to some extent accelerating in the Dow, although the NASDAQ is not as bad as it was yesterday. The Dow's down about 3.7%, 1,500 points this hour. The NASDAQ's down 4%. I believe it dropped 6% yesterday, although tech does continue to struggle. Apple's down again. Amazon having its worst week since 2022. Any chip and AI-related stocks continue to fall. Again, raising the question, how much of this is air coming out of the balloon? How much of it could be an opportunity for one innovation cycle that should continue to some extent? And the home builders are bucking the trend. They're in the green with rates falling today.
Yeah, China-based ETFs also sliding on that country's retaliatory tariffs. Remember, that's one of the reasons we're seeing another leg down today, is that China coming out and saying, okay, you want to raise tariffs on us? We're going to raise tariffs on you. You got all these different China ETFs, FXI, KWEB, and others. They're all falling, except look at Vietnam, the VNAM. That is up 4%. It's because, as you saw the headline and Hayman talked about it, there is a chance, Trump came out and basically said that Vietnam may cut its tariffs on U.S. products to zero. So one wonders, Kelly, does that make us cut them, as the president said, to zero, and we start to see some of these deals being made?
Little glimmer of hope here, but a lot to be learned. DuPont, by the way, leading the declines in the S&P. China regulators now investigating the firm for violating anti-monopoly laws. As part of China's retaliation announcements, there were other things in there, like they're restricting some rare earths, they're restricting some imports of certain poultry and sorghum. So there's a lot going on that front.
Yeah, I mean, they just decided to open up an investigation into DuPont on the day they announced retaliatory tariffs.
Yeah. Oh, by the way.
I mean, China, could you wait a day? At least make it look valid. All right, finally, oil prices tumbling to their lowest level since late 2021. You wanted lower gasoline prices, folks? You're getting them. They're on the way. Copper having its worst single day since 2008. So obviously, I think you might have gathered from the top of this show and the exchange, there is a lot to talk about with your market, stocks, and your money. The tariff sell-off continuing. The Dow losing over 3,000 points in just 2 days. Many indexes are now in technical bear markets, down more than 20% from their highs. China retaliating. The payroll numbers this morning actually came in hot, sort of re-raising inflation fears. Fed Chairman Jay Powell saying the economy is still strong. Oh, and the president pushing the Fed for a rate cut on his social media platform. Other than that, not a lot going on. Let's talk about all this and more. Kyle Bass, founder and chief investment officer at Hayman Capital Management. I don't even know where to start, Kyle, so I'm just going to throw it right out there. What do you make of the stock market action the last couple of days?
First of all, Brian, pleasure to be here with you. Look, I think it's important to think about kind of the real big picture for a second. The Fed's balance sheet went from sub $1 trillion in 2008 to $4.5 trillion by 2019. And then from 2020, when the COVID hit, it went from $4 trillion to $9 trillion in 2 years. We added 40% more money to the system in 2-year period. So we got about 40% inflation. In fact, the housing index, the government's own housing index was up 50% during Biden's term. So now the Fed has actually reduced its balance sheet by 25%. It's gone from $9 trillion to 6.7. And the Fed continues to quantitatively tighten on a daily basis. So there's no real structural positives from a monetary creation perspective to support the stock market. And now the tariffs are scaring investors. So, I think the tariffs are thoughtful. I think they will work. I think you've already seen Vietnam ask for a 90-day reprieve to negotiate. You're going to see a lot of first class plane tickets from delegations from all around the world coming to meet with the president to try to hammer this out.
Okay, let's go back. Let's go a little more into that word work, okay? Because we're CNBC, and I understand that a lot of people don't own stocks, but we serve that community. If we're looking at the screen right now, Kyle, it's red everywhere, right? I mean, markets are not, I hate to use the term collapsing, but they're down 8%, 10% in 2 or 3 days, and many are in technical bear markets. How would you define working with regards to the tariffs?
Look, how many times have you heard people complain in desperation and talk about the size of our deficit being $2 trillion on government revenues of what, $4.5 trillion? We must cut our deficit, Brian. The whole world's told us that. Our own economists tell us that. And so when Trump moves to do a couple of things that will close that deficit. Number one, if Doge and Elon Musk are successful in cutting government expenditures, cutting the fat, let's say they cut, I don't know what your number is. I would say 400 to 600 billion is doable on a number of 6.5 trillion. That will be cutting 10% of government spending. U.S. government spending is 23% of GDP. That is a recessionary impulse, but it's necessary. The tariff move is akin to a currency devaluation. It will raise somewhere between 300 billion and 600 billion in external revenue. There's a path that Trump and Secretary Bessent are talking about here, taking us to showing us how we cut $1 trillion out of that deficit, right? When I talk about working, we're going to cut our deficit by $1 trillion, and we're going to reset what the term fair means with reciprocal tariffs. And so, yes, that's going to be difficult in the near term. In the long term, it's going to give us a positive foundation for growth.
Okay, so let's play devil's advocate on that point, Kyle, because I don't fundamentally disagree with you. There are a lot of 28-year-old, 31, 35-year-old viewers that are watching or listening right now. They don't own any stocks. They're trying to buy a home. It's too expensive. Mortgage rates are too expensive. Hell, everything is too expensive. We've talked about bringing down inflation and bringing down the price of energy. Okay, all those things are going to happen. Interest rates are coming down. Mortgage rates are coming down. Energy costs coming down. So there's a lot of people out there that maybe quietly will say, well, I don't own stocks. I don't really care about the Dow. This isn't the worst thing. But here's the problem. If you crash the economy to do it, if people lose their jobs and thus can't afford to buy the home, then what? What is the risk? We seem like we're walking a tightrope, Kyle, where, hey, if we can pull this off, that's great. But what if we fall?
Yeah, I mean, the real risk here is 10% of the top 10% of U.S. households represent 50% of consumption. Consumption is 68% of GDP. So the high end of the U.S. is what's been spending to keep our economy growing, and that's what's been driving jobs. So will that slow down? Yes. Look, I expect just with pure math, I expect U.S. GDP in real terms will drop 1.5% to 2%. Is that the end of the world? No. Could that change the psyche of investors and their spending? Potentially. But that's why, look, the Fed will be late. For certain, they'll be late. You can even hear it in Powell's response to the president asking for a rate cut. Certainly the yield curve will steepen. The front end's got to come down because the next two GDP prints are going to be difficult. It's going to look stagflationary, but it's going to get a lot better after that. And again, this is a restructuring we must engage in, Brian. We couldn't keep going the way that we went. Housing prices were up 50%, 50. If you look at the government's own housing index between 2020, 2024. And yes, there was a different president in the White House then, but it was a cost of living crisis caused by Congress and the Fed. And now what we're trying to do is reset kind of the crazy price moves that we saw over the last 4 years. And it's difficult. It's going to hurt. But it's akin to a controlled burn. Are we going to have the Palisades fire? Or are we going to have a controlled burn with thoughtful leadership? I believe this is a controlled burn. I also believe that, what's the NASDAQ down year to date, like 16, 17, the S&P's down 13.5. Look, the president himself and the administration, there is a put somewhere. My guess is it's somewhere down another 5-6% from here. So when you're asking 31-year-olds, 28-year-olds when you buy, you start buying in the next couple of months.
Kyle, can I quickly ask you, as such a close observer of China, are they going to have to devalue? Is the rest of the world, as the Wall Street Journal is writing, going to be flooded with cheap Chinese goods? Imagine how that'll complicate things for Europe. What other, if they devalue, are they going to have currency flight? Is none of this going to matter because retailers are charging $100 on a U.S. item that costs them $5, and so now it'll cost $10? So what are the possible responses there? And it's interesting that their market is down worse today on their retaliation announcement than it was when we announced the 46% tariff.
Yeah, I think that the general narrative around China is just wrong in the media. And what I mean by that is China has 3.5 times the size of their banking system that we do as a percentage of GDP. They've already been dealing with an economic collapse for the last 2 years. We import about $440 billion a year from China. We run a $30 trillion economy. We only export about $140 billion to them. If you want to do tit for tat retaliatory tariffs against us with a relationship like that, we win, because there's very little for them to tariff back to us. So Kelly, when you think about where China stands today, they already were broken. They already have a closed capital account. The fallacy in this concept of Chinese currency strength and weakness is they have a closed capital account. They're not a real open economy. And so their strong currency actually works in their favor. And what I mean by that is they have to pay dollars for everything in the world. They're the largest importer of crude oil, 13 million barrels a day, largest importer of LNG, about 9.5 Bs a day. And they import 40% of their food every single day, and they must pay with dollars. A devaluation of their currency is a disaster for them, in my opinion.
So that's why they're retaliating with tariffs. They have little other choice. There's not much else they can do.
I mean, look, Xi wants to project strength, and he's in the weakest position he's ever been in his presidency, especially economically speaking. So our slowdown, if it's intentional, which I think it is, to reset our spending, our expenditures as a government, really has a knock-on effect on China. China is really going to suffer if the West slows down, because the West has been the growth engine for the world for many years, really since post-financial crisis. You've seen the West take over. So I think if the West is going to slow down, it's going to really impact China, because they were already having trouble with the construct of their economy.
Yeah, and your point is well taken. We only sell about 140 to 160 billion to them. There are companies that will be affected, the Teslas of the world, the Starbucks, the Nikes, but overall, they don't buy a lot of our products. And by the way, if you go to China, as I've been there a few times, there's no Twitter, there's no Google, most Microsoft products are pirated or stolen. So different issue. Very quickly, Kyle, I want to sort of tap your big brain on the markets. I posted something from JP Morgan's derivatives team talking about forced volatility selling. Can you just, in layman's terms, sort of take us just quickly into the market? How does selling beget selling? Because these are not all people dumping their 401ks. In fact, yesterday, we saw billions in retail buying. So the mechanics of the market, what's happening?
Yeah, I mean, there's a ton of cash on the sidelines. That was part of the Fed's jubilant expansion of their balance sheet. So number one, there's a lot of cash on the sidelines. Number two, that you're asking about how selling begets selling. A lot of people run these things called value at risk models. Value at risk models have a component there of, call it volatility. You know, when the VIX hits 40, historically it has been a great time to buy things. And so when the volatility spikes, the value at risk number expands, and it requires selling to sell down risk. And it's a crazy model. But it is what it is, and selling does beget selling. And so again, if the Fed is not going to be accommodative, and if you heard Powell, what he said today, he's telling you he's certainly going to be late to the party. He's certainly not looking to help President Trump. So I think if they're out of the picture, and in fact they're still quantitatively tightening, and you've got a scenario where we are not bluffing on the tariff side, we are here to reset trade relationships. You know, we might have a short-term turn and bounce, but you're going to see the economy begin over the next 6 months. And then we're in a great spot to grow. We're in a much better fiscal position. And look, I applaud what's happening. It is difficult medicine to swallow, and we all own stocks. Like, I'm not short anything, just to be clear. I'm not talking my book.
I was just about to ask you, because I know you know best. I was just about to ask you, do run a fund. If you're short, you are not one on the record. Very quick, we got to go. But Steve Leisman, who's not here, but he emailed me a question to Kelly as well. How do we blame quantitative tightening when the Fed just backed off to almost zero? Can you answer Steve's question real time?
Yeah, I mean, the Fed has reduced their balance sheet 25% over 2.5 years. What do you mean? How can we? Like, I'm not trying to assign today's decline or yesterday's decline to quantitative tightening, but the fact of the matter is we've reduced our balance sheet. The Fed has 25%, 2.5 years, and the Fed's down to $5 billion a month or $60 billion a year. But that's certainly not accommodating anything. So all I'm pointing at is the arrows. If you look at If the Fed reduces its balance sheet 25%, there are multiplicative effects on the economy. What I'm saying is no one's talking about it, and it's actually functionally relevant to this conversation. It's just not relevant on a day-to-day basis.
Kyle Bass, Hayman Capital Management, taking viewer questions live on the show. Only you could do that, Kyle. We appreciate it. Thank you.
It's a pleasure.
All right.
Let's turn to Rick Santelli now as we watch those bond yields sinking. We went under 3.9 this morning. Kyle just said the 2-year should go way lower and the curve should steepen, Rick. What's it all going to mean?
Well, I think the curve could steepen real quickly. I want to dig in on something that Kyle just said that was also in the Journal. The Journal this morning said we import $400 billion from China. Kyle Bass said $440 billion. Think about that number. Now, I'm going to ask you a question, Kelly and Sully. What size budget deficit do we currently have, roughly? About $1 trillion?
About two.
Okay. Yeah.
Think about $1 trillion plus on the deficit versus all the entire imports from China are less than half of that deficit. That really frames out the problems that we have.